Happy New Year, and we start 2025. After the initial euphoria of the election of Donald Trump and the expectation of deregulation in markets, the formation of his future government has started to come into place, and we've seen some issues come through that perhaps the outliers we were concerned about in terms of his policy and how he interacts with other nations.
President-elect Trump will be inaugurated in just under 2 weeks, and he brings with him plans to reduce regulation in the U.S. economy, to lower taxes, to use tariffs to motivate the behavior of the U.S. trading partners into ways he thinks are more favorable. And when I say tariffs, he's talking about large and punitive tariffs on many of the exports that the U.S. takes in from countries like China and Mexico and many nations in Europe as well. And the scale of that's going to be really critical in terms of what it does to the economy and how other countries react. And he's also talking about, sealing off the U.S. borders and reducing illegal immigration and literally removing illegal immigrants that are already in the U.S. At a scale that is quite significant and alarming.
The other key factor towards the end of the month, which upset the euphoria of the expectation of a Trump presidency, was the Fed throwing some cold water on markets about the expectations for rate cuts in 2025, expecting a much slower rate as they see the strength in the US economy continue to grow. This is one of the things that we are looking at, effectively a divergence in interest rate policy across the US, Europe and the UK into 2025 as we see the economies start to move at different paces and the inflationary aspects that impact that. In Europe, we're expecting rates to be cut at a much faster degree, as they were the initial people to cut rates already, as we see concerns about slowing economy in Europe and how the ECB deals with that. On the basis of this, we have made some adjustments into the fixed interest element of the portfolio and introduced an element of euro fixed interest exposure to benefit from where we see a potential uplift as rates start to lower.
Central banks, namely the Fed, the Bank of England, the ECB, maybe to a lesser degree the Bank of Japan, they're all starting to move now much more because of what's happening in their domestic economies and the way inflation is progressing in each of these economies. So they're moving at different speeds. Now the pace at which they're going to adjust policy, I think, is going to start to diverge, and this is going to produce more volatile exchange rate markets, and it may also carry over into fixed income markets as well and move them in ways that are much less correlated with one another. So that will provide opportunities and also, I think, surprise.
In terms of interest rates and fixed interest markets, again, yields started to push higher towards the end of December. This is on the back of the concerns the Fed raised about not cutting rates so quickly. Again, this caused a pause in equity markets in the last week or so of December. As we've mentioned previously, the differential between shorter rates and the 10-year rates was very minimal. We're starting to see the 10-year rates push up to higher levels now, we think are more attractive, and this is one of the things into 2025 that we'll be looking to adjust the portfolio to take advantage of these higher rates at the 10-year level. In terms of equities, the stronger performers were in the tech sector for us again, and we introduced positions in technology into the portfolio over the last quarter, and these have done well for us into this last period of the year. So in all, the equity content of the portfolio has been relatively defensive over this last period of the year. The holders we've had are in good stead and good quality investments, and despite the setbacks we've seen in terms of expectations for interest rates, they actually held up relatively well to the market.
I think some of the themes that we stressed in the fourth quarter last year are going to keep serving us well, namely European defense. The actual war in Ukraine is forcing them to spend more on defense, and I think this is a secular trend that's going to keep running and should do very well for us. Also, we're seeing yield curves normalize, that is, short rates getting below long rates. This is very good for financials, and we expect to see continued outperformance from banks.
Going forward, it's going to be this differential in interest rates and currency, and in fact, weakness of sterling over the last period has helped with the portfolio with the US dollar exposure inside the portfolio. And this is going to be a key theme over the next year. We think will continue to be of importance to investors in terms of this differential in interest rates and the strength of currencies. As a global portfolio that we manage, this is one of the things that we are looking at and how we look to take advantage of this for investors.
Wish everyone a good and prosperous 2025, and I reassure you that Nick and I are working the best and the hardest we can to ensure successful outcomes in your portfolios.